understood part of any accountant's life, particularly if he recommends that you don't take it. I don't know how many of our clients tell me that they have not taken the home office deduction because their accountant has told them not to. I'm hearing some sound on there. Is that you, Mike?
Oh, yes, sorry.
Am I coming through now okay?
Yes.
Apparently I didn't for the first half hour.
Oh, sorry. I'm doing myself now.
Okay, very good. So today we're going to talk about that home office deduction. Before we do that, I want to, well, let me tell you why I think it's important for you. In my humble opinion, your biggest job as a business owner or a business manager is managing your cash flow. Managing your cash flow, because without cash flow, we're in a world of hurt, aren't we? So if that's the case, then every dollar that we spend comes away from it. Every dollar that we can save could help our cash flow. One of the ways we can save those dollars is by being able to deduct items. So I want to show you today how we can use a home office to deduct. But first of all, I have to give you the disclaimers that the government requires us to. You read them. And then our contact page. Okay, the business use of your home. Your CPA has told you you don't want to do it. It'll raise a red flag. Well, this is straight out of the IRS book. With technology making it easier than ever for people to operate a business out of their house, many taxpayers may be able to take a home office deduction when filing their federal income tax. Furthermore, they have a complete publication dedicated to home office deductions. It's IRS Publication 587. If you'd like to see what that looks like, you go to irs.gov. They've got a great search engine. Just put in Pub 587. It'll take you right there and you can download it. It goes on to say that the term home includes a house, an apartment, a condominium, a mobile home, a boat, or similar property, which provides basic living accommodations. It also includes structures on the property, such as an unattached garage, studio, barn, or greenhouse. What we're going to cover today is the requirements for qualifying deduct expenses on your business use of your home, the type of expenses you can deduct, how you figure the deduction, selling a home that was used partly for business, deducting expenses for furniture and equipment used in your business, records you should keep, and what forms are you going to use to satisfy Uncle Sam. Now, to qualify for a deduction, you have to use part of your home exclusively and regularly as your principal place of business. Generally, you can't deduct items such as mortgage interest, real estate taxes as business expenses. Now, the reason being, you can deduct those straight off of your 1040, and you can get 100% of it. We don't want to get just a percentage for the home office. An employee can also qualify for a deduction for business use of their home if your employer has asked you to work from home, and if your employer has not paid you for the use of your home. Now, what does exclusive use mean? It's a specific area of the home where you work on only your trade or business. It doesn't have to have walls around it. We have many clients that have an area in their bedroom that they've got their computer and desk and everything else on, and they use that regularly and exclusively. But here, let me tell you, even if you have an office with walls around it and you work in it for a while and then your kids go in there and play computer games, you've done away with the exclusive use. Now, there are 3 other reasons you can get away from using it exclusively. If your home is part of where you store inventory or product samples, such as somebody that's in a multiple level marketing, or you use part of your home as a daycare facility. The third thing is if you see patients. Let's say you're a psychologist. Now, you can deduct expenses for the business use without meeting the exclusivity test when you store product samples. First of all, you have to sell the products either at wholesale or retail. You keep the inventory there. You use the storage space on a regular basis. And the space you use is separately identifiable. Now, the regular use doctrine, to qualify under the regular use, you've got to have the specific area. Past that, the IRS code doesn't give us any examples, but it's my belief if you use that exclusive area for your business up to 500 hours a year, that you can qualify as regular use. Now, trade or business use, to qualify, you must use part of your home in connection with the business. I'm showing a trader in securities here. That is somebody that is trading as a business. An investor, we'll go into in a minute, cannot deduct it. If you use your home for a profit-seeking activity that is not a trade or a business, you cannot take a deduction for its business use. As an example, you use part of your home exclusively and regularly to read financial periodicals and reports, to clip bond coupons, and to carry out similar activities related to your own investments. An investor is not in business, so therefore they cannot deduct it, because you've got to be in business to be able to deduct your home office deduction. It should be your principal place of business. To determine whether your home is your principal place of business, if you've got more than one, which is the most important part of your business? Where do you spend the most time? You can qualify as a principal place of business if you meet the following requirements. You use it exclusively and regularly for administrative or management activities, and you have no other fixed location where you conduct a substantial amount of time. Well, what are administrative and management activities? They're listed there. You guys go ahead and read them. Now, another thing, you can have more than one business utilizing that office in your home. Let's say you're in the multiple level marketing business and you're in the real estate business. You've got rentals. Well, both of those require an office, so you can use it exclusively for those two things. Now, you're going to have to be careful, because in order to deduct those from each of the different businesses, since you'll be filing different returns on them, you need to know what percentage of overall revenue each of those companies bring in. Let's say the rental real estate brings in 80% of your revenue and your multiple level marketing brings in 20%, then 80% of the expenses would be for the rental real estate. The one item that we didn't talk about back there is if you're a psychologist and you meet with other people in your home and it's on a regular basis, you can deduct the area within where you meet them. Also, if you're in the multiple level marketing business and you have a place where you meet with prospects, you can certainly deduct that part. Now, many people, particularly here in Phoenix, spend the winter here and the summer somewhere else where it's got those mountains that you've seen. If you're here for 6 months, you can only deduct 6 months of business use of the home here on your tax return. However, if you live in Idaho, this has got to be Idaho. It looks so pretty. Anyway, if you live in Idaho the other 6 months and you've got an area up there set aside for business, then you deduct that for the other 6 months. There is a limitation on what we can deduct. You've got to make money to be able to deduct it. But let's say we don't make money the first year we're in business, we can carry over that deduction. We can carry it over to the next year and take it. The first thing you need to do is to qualify as a business. And then you must qualify to deduct the business use of your home. Now, one of the things the IRS is going to look at is whether the expense is a direct, excuse me, an indirect or an unrelated expense. A direct expense would be an expense only for the part of the office. Let's say you're going to repaint the office. You don't like the sandstone color that's in there. You want to make it a nice light blue. Well, that expense would be completely deductible. Also, let's say you're going to put new carpet in there. That expense would be completely deductible. Indirect expenses are those for keeping up and running your home. Let's say that we have one of our giant windstorms come through and it blows half your roof off, and now you've got to replace your roof on the whole house. Well, you can do that and then take the percentage that your office is of the total house, and that would be an indirect expense that's deductible. Same thing if you paint the outside of your home. Indirect expenses, something that is for the whole house, but your office is part of the whole house. Unrelated expenses, let's say you're going to paint your living room. That's a non-deductible expense. There are a couple different ways that the IRS will allow you to figure what your deduction should be. And you need to use whichever one is going to get you the most bang for your buck. The first way is to measure the inside dimensions of your home. Let's say they're 3,000 square foot, and then you measure the inside dimensions of the room that you're using exclusively as your business office. Well, then 10% of your indirect expenses, your home expenses, would be deductible. We're talking about a lot of things here. We're talking about utilities. We're talking about the roof, the paint, various other expenses that you have would be deductible according to this at 10%. Now, the other way is if your rooms in your house are all about the same size. And let's say you've got, for the ease of my figuring, 10 rooms, and you use one of those rooms for your office. Well, again, this would be a wash because that would be 10% that you could be able to deduct. Now, there's a lot of expenses that we could list that you can deduct. There's a few of them here. Now these are deductible whether or not you use it for business. These are on your 1040. But if you use your home for business, here's some more that you can use as a percentage. And if you're in an apartment, you can use a percentage of the rent you're paying. Now let me be clear on one item. Some people want to charge rent to their business. In order to do so, you're going to have to depreciate that office. Once you start using depreciation, anytime you go to sell the house, you're going to have a world of hurt because now you have to add the depreciation back in. So to my way of thinking, it's much better not to do that. Not to take depreciation. That's what I mean by that. Now, most of us have owned equipment before we set up our business. We've got our computer, we've got a desk, we've got a file cabinet, who knows what else. Well, we might as well sell those to our business because it's going to give us more cash flow. You're going to sell it at the fair market value on the day that you sold it to the business. Now, there are different types of property you're going to sell to your business. Your listed property, you must use it more than 50% to deduct it as Section 179. Now, Section 179 is the section that allows you to take the whole cost of equipment and deduct it in the year that you bought the equipment. If you can't use Section 179, then you've got to depreciate it using the depreciation tables that the IRS has. When you buy property for business use, you want a new computer? You can use it all as Section 179 and deduct that cost. Or you can split it between Section 179 and depreciation. Why would you do that? Or why would you just depreciate it? Well, if you know you're not going to make much money this year, but you think next year is going to be a lot better, you may want to depreciate it so that you can get the deduction in the years that you're going to have good sales or good revenue. Now, on the personal property that we convert to business use, we can't use Section 179. It's all got to be depreciated. And as I said before, the basis that you're going to use is the fair market value. The biggest thing you have to do is to keep records, folks. One of my biggest hobbies is to go through the tax court cases each month that are in the U.S. tax court. Probably about 10% of those are small business people who filed their tax return. The IRS, excuse me, I've got the Arizona crud. The IRS has audited them, picked them for an audit, and they didn't have any documentation on their expenses. Now, why they even fight past that point, the IRS is going to disallow those expenses because you have to have them. And for some, it's even more grotesque than others, for automobiles, for example. But you must have records that prove the information. Remember, as far as the IRS is concerned, you're guilty until you can prove yourself innocent. It's just bass backwards from our judicial system. So my recommendation is you draw a map of your home showing the area that you are going to use exclusively for your home office. I truly believe you should take pictures then. I've got a personal reason for that I'll go into in a minute. And I think you should have a day timer on your desk. The day timer is keeping track of how many hours you're working in that home office each day. Because remember, if you're audited, it could be up to 3 years from now. You could have even moved to another house. So you've got to prove to the IRS that you had a home office. Do your documentation. Now, the reason I believe you need to take pictures, I said, was personal. We had a summer home in Yarnell, and for those of you who remember, we had a fire up in Yarnell a couple years ago. Pretty drastic fire. Our house was the last house on the south end of town that burned. I had always heard that I should have taken pictures of all of my property that I had stored in the house, but I never did. I'd rather watch television than take pictures. Well, when it came time to give the information to the insurance company, my wife Melva and I sat there for days on end trying to remember what we had in each closet, what we had in each drawer. And if we got 20% of it, I think we did a good job. So take pictures of your home office. That's for the IRS. Take pictures of your home for your insurance company. Now you need to keep these records for at least 3 years past the time that you filed your tax return. But if you stay in the house, remember it's going to be 3 years then from the date that you filed the tax return, from when you shut your business down, sold your business, or quit using a home office. Where do you deduct it? Well, it depends on whether you're classified a self-employed person, a C corporation, or a partnership. As a self-employed person, you're going to file Schedule C with your 1040, and your business expenses will be there. You also need to file a Form 8829. I know you guys are going to remember these numbers. Employees, as an employee of a C corporation, you itemize your deductions on Schedule A of 1040. Also, if you are an employee that your boss asks you to work from home and you're deducting your business use of your home for that, it would go on the same form. If you're a partner in an LLC or a partnership, and if you were required to pay ordinary and necessary expenses on behalf of the partnership, then you're able to deduct the expenses. But make sure that you have a resolution in your LLC or your partnership that says that you can do this. 5 facts about the home office deduction. I'll let you read those. And again, I read from the IRS summertime tax tip. With technology making it easier than ever for people to operate a business out of their house, many taxpayers will be able to take a home office deduction when filing their federal income tax. Our next webinar will be next Thursday at 12 o'clock. We get into the really nitty-gritty travel, entertainment, and car expenses. Very important. Probably completely different than what you think it is. Also, I'd like to put a plug in for our website. I hope you've been there, www.smallbusinessfinancials.com. And also, you can sign up for our webinar. You can sign, our newsletter. I looked up and saw the word webinar and just repeated it. We've got a great newsletter that comes out. Sign up for it there and you'll learn a lot. Now, I appreciate your attending. I really do. I'm sorry for the problem with the sound. I don't know what happened. I've got to investigate that. I'd like to answer any questions that you might have now. Let me open up my question box. Okay, Liz. Okay, any questions, folks? I don't see any other than what happened to the sound. Okay, very well. I'll go eat lunch then. I appreciate your being here. Hey, for next week's webinar, if you know somebody else that you think should be sitting in on it, be sure and tell them about it. We'd love to double the number of people we have. Thank you now. Bye-bye.